Hello, and welcome to this lesson, which will show you how to set winning growth strategies for your organization. After you have finished this training, you will be able to, firstly, understand the context of growth strategy. Secondly, identify the key frameworks and levers for evaluating growth opportunities. And thirdly, understand what a typical growth strategy work plan looks like. To begin with, let's look at the context of growth strategy. Organizations regularly grapple with the growth challenge. Questions about how to set strategic priorities in a low-growth environment, how to find new and better strategic options for your organization, or how to allocate capital across competing alternatives, and how to do all that in a way that results in the right long-term aspirations for the organization, which could be profitability or market share growth. Here are some examples of organizations who overcame stagnant growth. You'll learn more about Porsche later, but the German-based retailer Hugo Boss overcame stagnant growth in the early 2010s with the introduction of new brands like Boss Orange and Boss Green, and expanded internationally through a franchised store program with particular success at airports. Similarly, the US-based company Arm & Hammer developed a core competency in baking soda and washing soda, but following periods of stagnant growth since the 1970s, it has since expanded into new cleaning and freshening categories, including toothpastes, deodorants, and even pet care. The goal of growth is to create shareholder value. As the famous investor Warren Buffett once said, "The investor of today does not profit from yesterday's growth." Hence, organizations need to grow to create value, which means to give financial returns to investors. Returns require investments to generate growth in profits, and profits require revenues to grow more than costs. Returns that are higher than what investors demand are said to create value, and to measure shareholders' value creation, I use a metric called Total Returns to Shareholders, or TRS for short. TRS is a precise metric used to calculate the shareholder's return on investment over a period of time. It is calculated by taking the sum of the change in the share price and the dividends paid in the period of question, divided by the starting share price. The resulting percent increase or decrease represents the value created or depleted over the return period. Please refer to the slide for the TRS calculation. If you drill down into the TRS calculation, at a first level, you find that earnings growth is a key driver for sustained shareholder value, together with two other main drivers, which are changes in valuation and free cash flow contribution. Drilling down to a second level, you can, for instance, see that revenue growth and margin are key drivers of earnings growth, and that operating cash flow, long-term capital investments, and working capital all drive free cash flow. Using these first and second level inputs, you can devise an alternative way of calculating TRS, which helps to unlock the various drivers of TRS and how organizations create value for their shareholders. Please review the slide example for how to do this. As the TRS calculation has shown, organizational growth per se is not enough. In fact, some growth can be detrimental to an organization's value and lead to negative TRS. To generate value, an organization should aspire to growth and a positive TRS, and you can term such organizations the uphill growers, which means they usually deliver growth at twice the rate of their peers, sustain growth for at least 5 years, and thirdly, create a positive TRS over the same period. Let's look at one of these uphill growers, Porsche. By 1993, Porsche had posted 6 straight years of revenue decline and was the highest cost per unit car manufacturer. Its CEO at the time emphasized a culture of craftsmanship sports car performance. He rejected moving into adjacent segments, claiming an entry-level Porsche is a used Porsche. Meanwhile, foreign competitors were bringing performance to a wider audience at a better price. Volume sank, and bankruptcy loomed. The CEO was replaced by a new CEO, who ambitiously saw Porsche as a bigger fish in a bigger pond. First, he cut production layers from 6 to 4, which reduced the build time of a 911 from 128 days to 45 days. He took Porsche from one of the highest cost per unit manufacturers to one of the lowest. He also scrapped the underinvested and underperforming 924 and 944 models, which earned Porsche the right to grow, creating necessary competitiveness and investment funds. Next, he reinvested in the neglected 911, with performance improvement, which strengthened a financially crucial model and the brand overall. Next, the CEO embarked on systematic expansion into adjacent segments. The Boxster brought performance to a lower but aspiring income level and a new demand funnel for the entire range. Next, the Cayenne brought performance and practicality to the SUV segment. The 4-door Panamera followed, which was the most successful US launch in Porsche history. Work then began on an electric hybrid. There are some growth lessons from this success story. First, pursue growth in its proper order. Achieve operational soundness first. Next, reinforce the core. Then expand into adjacent segments. Second, across that sequence, exploit your unique advantages. At Porsche, performance remained the essence of the brand, which proved to be a differentiating ticket to adjacent growth. And some Porsches were built on a production line with Volkswagens to help save costs. This strategy saved Porsche, tripling volume between 1994 and 2004, and doubling again in the last 10 years, as each extension brought incremental volume and growing profit. Across the period, TRS averaged 19% per year. The Porsche experience is only one success story, but other great organizations like Starbucks and Toyota have managed to destroy value by focusing on revenue growth only. During 2006 to 2008, Starbucks faced a period of declining TRS despite growing revenues, and only managed to restart growth by avoiding adjacent distractions, and sought to do one thing well, which was coffee. And during the same years, Toyota was prioritizing growth at the expense of other operating objectives like safety, quality, and volume, and TRS declined. There are 5 pitfalls to avoid when your organization is pursuing value-creating growth. Firstly, avoid giving away margin to increase sales. Instead, focus on non-monetary value differentiators, such as quality or technical leadership. Secondly, avoid increasing risk by growing too fast or moving into riskier segments. Risk can be managed by growing moderately to preserve cash, and moving into adjacent market segments rather than new or high-risk segments. Thirdly, avoid investing too much capital for limited additional profit, a tactic often pursued to win market share. Instead, focus on margin preservation. Fourthly, avoid mistaking large potential revenue pools for large profit pools. Ensure competitor due diligence takes place to check the available margins. And finally, avoid investing where you don't have competitive advantage. Focus instead on segments where you can actively differentiate. In this second section of the lesson, you will look at the key frameworks and levers for evaluating growth opportunities. So, how do uphill growers do it? What is their probability of success? What moves did they make? And what are the patterns that emerge? What matters here is an organization's starting position. It impacts the likelihood that growth investments will create value, and it matters in terms of the types of competitive moves that create value. I defined starting position along two dimensions. The first is competitive premium. Does your organization command a gross margin advantage versus the competition or not? For example, if you look at US grocery chains, Walmart achieves this through supply chain efficiencies, Target through clever marketing, and Kroger through excellence in store operations. Others may have powerful brands, or control points in the value chain, or have scale. The second is competitive stability. Is the game you are playing one of equilibrium, which is characterized by steady market shares, stable demand, and high entry barriers, or turbulence, which is characterized by ease of competitive entry, disruptive technologies, and changing consumer behaviors? By adding the probability of value-creating growth for each quadrant, you can see the importance of an organization's starting position measured in terms of competitive stability and competitive premium. In the top right quadrant, organizations command a competitive premium in a stable game. Of these organizations, our research suggests 83% created value through their investments in growth. Their advantage is insulated by entry barriers, relationships, loyal customers. In the top left quadrant, businesses are disadvantaged players in a stable game. Here only 17% of players saw a value return on their growth investment, because it can be hard to win market share. Also, due to a lack of differentiation, it can be hard to change your competitive position, and with limited cash for investment, returns can take time to materialize. At the bottom of the chart, where the game is turbulent, competitive premium matters less. The odds of valuable growth approach 50-50 in both quadrants. This is intuitive. Turbulence implies that advantage today may not be an advantage tomorrow. The churn in a turbulent sector offers growth opportunities to winners and losers alike. But whatever the starting position in the quadrant, it is possible to create strategies that generate value-creating growth. Now let's look at three starting position archetypes, each with a distinct path to value-creating growth. Firstly, the fortress archetype. Value-creating growers with this profile, like Procter & Gamble, typically reinvest some growth capital to reinforce their core premium, then project that advantage into close-to-home adjacencies. They look just beyond a stable core to exploit their advantage. Secondly, the fading archetype. The 17% who defy the high value creation odds typically reshape their portfolios and pursue a more distant adjacency. For example, Ford focuses on the slow-moving core, but faces increasing competition from Far Eastern manufacturers like Nissan. More often, the value-creating course for fading players is to attack their premium disadvantage first by moving to the top right quadrant and then investing in growth, like Ford is doing with the Mustang. And thirdly, the fluid archetype. Rather than pursue a single long-range growth bet, successful growers like Amazon place a bet portfolio across core, adjacent, and distant frontiers. Experiments are rapidly killed or scaled as results unfold, like with the Amazon Fire mobile phone. Success comes not from foresight, but from competitive agility. For each archetype, Here is a summary of the suggested growth paths. With the fortress archetype, the approach is to grow by maximizing the core. With the fading archetype, the approach is to grow by exploring new frontiers. And with the fluid archetype, the preferred approach is to grow by a combination of expanding into adjacent markets and exploring new frontiers. One example of the fortress archetype is Gerber Baby Products. It maximized the core by moving from glass food containers to plastic containers. It then expanded into a new market, leveraging their trust with parents and carers to create Gerber Life, which is now the second largest life insurance player in the US. As you can see from the slide, each archetype differs in how much emphasis it puts on core, adjacent, and new frontier opportunities. The numbers in shaded blue indicate roughly the relative focus, with 100% distributed across core, adjacencies, and new frontiers. Now that you have considered the starting position when developing a growth strategy, you need to turn our attention to evaluating the growth options available to an organization. The slide outlines a framework that can be used to map out growth options. The Where to Play axis is the markets you choose to pursue, and the How to Win axis is the method of accessing a market. The framework defines 7 growth levers that span the growth opportunity space. In general, many organizations have a bias towards limited parts of the framework. Although organizations shouldn't spread themselves too thinly, they can benefit by stretching their thinking and using several parts of the framework to challenge their current growth plans. On top of the framework lies the corporate portfolio strategy lever, which identifies areas to accelerate growth in the current portfolio and seeks out new platforms for growth. Inside the framework are concrete growth opportunities. Firstly, go-to-market transformation. This captures near-term growth by increasing demand, market share, or penetration in current fields of play, for example, by improving customer understanding and marketing. Secondly, by geographic expansion. This is where organizations successfully enter and compete in new geographies. Thirdly, innovation is about generating concrete ideas to add to the organization innovation pipeline and ensure they are translated into new products and growth. Next, M&A, or mergers and acquisitions, is about acquiring or partnering for growth. From searching for opportunities to ensuring successful integration. And lastly, business model innovation. Here, organizations identify opportunities and realize growth by changing 2 or more elements of their business model. For example, a product manufacturer introducing a service, offering and changing its pricing model. The final lever readies the organization for growth and creates a growth mindset. For example, does it have the right leadership team, and is it focused on growth? How should the organization be structured? And what culture should it reinforce? The growth levers seen on the previous slide can be prioritized based on the opportunity size and how feasible it is for the organization to act, as shown in the slide example. The list of priorities can be used in senior management discussion and debate, and acts to guide future strategy work, such as mergers and acquisitions screening. Let's look at some of these levers in more detail. An analysis of growth opportunities with a proximity to the core is a quick way to prioritize opportunities. Adjacent opportunities are in markets that are close in proximity to what the organization does already, or where it does it. Like in the example on the slide, a paper wholesale distributor could target the wholesale distribution of other office supplies, like printer ink, and rather than distributing to offices, it could start distributing to homes and small businesses. A common misunderstanding about adjacent markets is that it's about exporting an organization's existing products to new customers. This is not true. Rather, the organization exports its skills and capabilities, not products and services. In other words, it is taking the organization's core competencies and creating new value with new customers. Exploring market segmentation maps to detect white space gaps in offerings within the core is a useful way to identify blind spots and previously underserved segments. Gaps can be examined across dimensions of geography, customers, products, channels, and the value chain to uncover any anomalies. Once gaps have been identified, strategy managers should seek to understand if the organization can replicate the previous drivers of success achieved in other core segments. Further analysis can be conducted to review the industry landscape for potential merger and acquisition opportunities, using the framework shown in the slide. It allows strategy managers to screen opportunities across multiple players by reviewing standalone economics such as potential deal size, the business strategic fit, including potential synergies, and should refer to any value upsides and risk. Such analysis should also assess how deals might affect sources of scale and competitive advantage in the industry, and assess potential integration and synergy risks. Why not put your learning into practice and identify growth opportunities in your own organization? One approach would be to, first, spend some time brainstorming to identify an attractive set of significant growth opportunities of where to play beyond the core. Then select from 30+ ideas the 3 to 6 clusters from which 2 to 3 opportunities with super high potential can be identified. And finally, evaluate and refine these opportunities to lay out the foundation of how to win. Idea generation can utilize multiple sources, both internal and external to your organization. For example, internal brainstorming workshops, reviews of intellectual property rights, key macro trends affecting your organization, and looking at how other organizations have innovated their business model. Also, take time to understand the key environmental trends affecting your organization. For example, how consumer buying behaviors are changing, and what changes are happening in the value chain. Once you have your growth opportunities, map and prioritize them onto an evaluation matrix, using some sensible criteria ahead of management discussions. The slide gives some examples of evaluation criteria. The outcome should be a small number of priority growth opportunities for the organization to focus its time, energy, and resources on, as shown in the slide. The key learnings from such projects are that, firstly, having a participative approach that involves many stakeholders helps to secure buy-in. Secondly, it can be relatively easy and quick to generate ideas in the right environment, but it can be more challenging to sort them effectively. Thirdly, there is a need to focus on the 2 to 3 key opportunities, and the level of effort from senior participants will be extremely significant for game-changing opportunities. And lastly, certain factors will play a key role in a project's success, such as the skills and know-how of key managers. But importantly, it requires a high level of determination and persistence from all participants to turn an opportunity into reality. In this concluding section of the lesson, you will review a typical growth strategy work plan. Before embarking on a growth strategy project, an organization needs to be sure it is ready for growth. The slide outlines a checklist focused on goal setting, organization structure, and metrics. Many unticked boxes would suggest more time needs to be invested with senior management to secure buy-in for a new organization-wide growth initiative. A typical growth strategy work plan is shown in the slide, from the base case research through to opportunity identification and evaluation, and finally execution. Timescales will vary for different organizations, but each phase should ensure an appropriate level of organizational momentum and motivation. In a large organization, the entire process should aim to be completed in approximately 4 to 5 months, or sooner for smaller organizations, which will typically require less stakeholder involvement. Please refer to the slide detail for specific tasks and actions. The next 3 slides demonstrate some case study examples of a growth strategy work plan in action. This slide describes the growth strategy plan and approach for a $20 billion consumer goods business, which led to core and adjacent growth agendas, and some M&A expansion, resulting in a 2 times TRS improvement over key competitors. And this slide describes the growth strategy plan and approach for a European supplier of hygiene services, which led to some compelling diversification opportunities that resulted in a profit margin increase. And finally, this example describes the growth strategy plan and approach for a consumer health organization struggling to find organic growth. The management team identified, launched, and piloted 10 growth initiatives, including improving its core category offerings, devising new marketing approaches and business models, and launching in new geographies. The subsequent impact was for these initiatives to be included in the growth plan for the organization, and the marketing department was reorganized to reflect the new growth strategy. To summarize this lesson, I have outlined some growth strategy best practices. Firstly, fully explore growth potential in the core in parallel with assessing new spaces. Secondly, when comparing alternatives, test what the organization brings to each new idea beyond capital. Thirdly, understand that growth is the most important driver of long-term value creation, but not all growth creates value. Fourthly, prioritize resources around repeatable strategies that can move the needle and move the organization into new spaces. Next, keep senior management directly involved as owners of the growth initiatives. They will set the growth aspirations that balance ambition with what is achievable. Also, keep an investor's perspective. Test the risk and return of capital allocated versus alternatives to drive value. The key is to avoid growing bad businesses. Fix these or exit them. And finally, set realistic expectations with the board and investors about how quickly the initiatives are likely to pay off. Thank you for participating, and see you next time on another exciting business training lesson from Pontema.